Welcome Alexandra Wilson-Elizondo, Deputy CIO of Multi-Asset Solutions at Goldman Sachs Asset Management. You'll talk all assets, Alexandra, but you're fixed income head of global credit at Mackey Shields for a while. So you are a bond and fixed income expert.
Yeah, I guess you could say that.
If anyone is, you are. I know we use the term loosely whenever we do that. So I think if I were to just summarize your thinking, we may not necessarily be out of the woods yet in terms of the Fed, of the tightening, of having a recession off the table.
Yeah, we, very much so like the market are expecting a hawkish pause today. And, while you're seeing things be, a little bit better on balance, there's an asymmetry in how they're going to approach this, in particular as it relates to being data dependent, because we're starting to see things like oil prices come back up. We saw what happened in Canada yesterday. Now, you are also seeing the reverse side of that, where you saw in England, a surprise to the downside. So, yes, it's a very difficult market to call. It's hard to say exactly where they'll be going, but we do think that they will keep that hawkish rhetoric in place. Even
the news backdrop that we see, the union, the UAW, this makes for bumpiness in the data that the Fed is going to try to analyze. But you think that the risk is that they need to be more hawkish with these things?
The risk is that they will be, because the primary asset that the Fed has is their anti-inflationary resolve. And they're not going to want to put that at risk. And so we do think it's important to pay attention to that. And in particular, the markets kind of push that to the wayside. And so while it's not our baseline expectation for the terminal rate to go up materially higher, it's a big risk, in particular as it relates to how people are positioned.
So they have to talk tough and look tough, even though they're not acting tough, but that can actually be self-fulfilling in the markets. The markets can pay attention to how they're acting, and maybe they don't have to do more. That's very strange, but all markets are psychology anyway, aren't they?
Yeah, there's a huge psychology to the markets. One of the things, as it relates to the pain trade that we talked about, and this is, again, it is not our base case scenario, but if you start to get anything in the terminal rate that goes up to 6%, we do think that brings things somewhat to a screeching halt because of the psychology of that handle of 6. And that would cause both consumers and corporates to completely reevaluate their willingness to do things.
And you didn't even breathe the word 7 or the word 8, and we had Nick Timros on, and we don't talk about Volcker anymore because we've decided no, nothing's the same. And then I'm suddenly looking at oil, I'm suddenly looking at wage price possible spirals, and we don't know we're not going to 7 in 2 years or 3 years, do we?
I don't think you can say that with certainty, and I think your point is very valid. So one of the things we've been focused on is that next year will be anything but average, and all you've seen is both economists and sell-side analysts, reflect back to say probabilities are lower. In fact, we've seen some probabilities that are the long-term average of recession for next year, and for us, it's hard to square that.
You think it's more likely than average that we have a recession?
Yes.
Stocks aren't cheap.
They are not cheap. I mean, it depends on what lens you're looking at it from. But if you're looking at it versus bond yields, you're actually at the 100th percentile in terms of valuations in the earnings yield gap since 2005. So you're not getting paid a ton to take a tremendous amount of risk right now. That being said, AI could lead to the investment and productivity to really keep things on the upswing. It's in particular as you start to see breadth across the index.
That's something you didn't think you'd be saying a year ago, isn't it?
That is very fair. But one of the things that
I just mean suddenly AI could save us in terms of productivity. I mean, that's amazing, isn't it? It couldn't save us in the 70s or 80s. So we really have to think about technology and how that bears on the economy and productivity.
Yeah, absolutely. And in fact, we're doing a lot of bottoms-up single name analysis. And when we look to allocate in our portfolios, we're very focused on active management and their ability to do that and really differentiate, because you have seen a rising tide lifts all boats. And so we do think like the next couple of quarters, you'll really start to see some of the rhetoric come out of, we're an AI company, and you'll start to see who really is and isn't.